Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Thanks again, everyone. This is another edition of All Things Financial. What we're doing, we're in the second part of a three-part series of year-end financial planning, including tax planning and protection and investment strategies that we could take advantage of near the end of the tax season. So this is part two coming right up. When we look at bonds, we typically see a lot of investors say, stocks are for risk and bonds are for safety. And we look at this and we say bonds, a lot of people consider bonds safe and think there's no risk in bonds. But there are risk in bonds. People that have attended my workshops before know that. Some of the risks in bonds are either a company or a government or a municipality borrowing money. So they're putting out debt obligations that investors can purchase, and the borrower, which is the municipality or the federal government or a corporation, is promising that if you give them money, lending in essence by buying a bond is lending them money, that they promise to pay you an interest rate or a distribution, a dividend yield, and refund the principal after the end of the term. So you buy a bond for a period of time. Well, what we find in bonds are we run the risk if a municipality or a company goes under, defaults on the bond, and is unable to repay the principal at the end of the term, and in fact may be unable to even pay the interest rate along the way. So you might lose your yield. You might also lose your principal. So there is risk in bonds on credit default. There's also a risk in bonds if you need your money prematurely. If a municipality borrows money from you by floating a bond, they put that money into the roads or they bought equipment. They are not able to financially refund the money directly until the end of that bond. So the bond maturity, they're obliged and obligated to repay you the principal. But what happens if you need money because you're going into a nursing home 3 years into a 10-year bond cycle? Well, you can't get the money back from the issuer. So you have to sell your bond to another investor. You have to say, hey, Charlie, hey, Joe, will you buy this from me for the remainder of the term because I need money I didn't think I'd need prematurely. So you go walk up down the street and ask everybody if they'll buy your bond and nobody buys your bond. You say, now what do? We need the money. We don't know where to go to get the money. Typically, you go to the open markets, you go to the exchanges, you call brokers, and they get the best available price for you that they can get. You know, it's like going on Craigslist. You get the market dictates. So here's the problem. First, maybe no one wants your bonds. Second, maybe no one trusts the issuer. Third, what if interest rates fluctuated between the time you first bought your bond? This chart is to show, while we're in a 0% environment, which we are, that even if you had a 7% bond in our old 7% times, there's still risk. I've talked about this before, but when you buy a bond, if it's extended for a period of time, not just a short-term bond, even they have a little bit of risk, you are subject to if interest rates change. Now today, where are we on interest rates? At historical lows. So where is the pressure most likely to force interest rates over a period of time in the future? More likely up, more likely down, more likely to stay the same? It depends on the Fed. The Fed is driving interest rates right now, not free markets. So if we get into a situation where interest rates are allowed to rise, that might run the risk that any bonds that we have today that are newly issued bonds might carry an interest rate risk on us, might carry an inflation risk, that if interest rates go up and I can't hold my money till maturity, I might not get my money back, or I might only get a portion. And this chart's here to indicate that. I have a 7% bond. Let's pretend we pay $10,000. I have a 7% issue rate that they're going to pay me, which means I'll get, on a $10,000 bond, $700 a year for 10 years, and then they'll refund the $10,000 to me. I need money, and interest rates went up only 1% from 7 to 8%. Look at this chart. In a normal market cycle, I will probably only get about $875. I will not get my $1,000 bond. I should have said 1,000, not 10,000. So a $1,000 bond means I'm getting paid $70 a year, 7%. I will lose $125, a little over 12% of my money, if interest rates just go up 1% between the time I bought it. If interest rates go down 1%, I make money. How can interest rates go down 1% from here? So our risk is very great in bonds, more than people think. Duration is the key in many bonds other than credit rates and inflation. The longer I buy my bond, the more risk I take. Now, what we're trying to do here, year end, again, is proceed with caution. We're trying to be careful with where we move money, how we move money, and where we place it. We're talking about some successful keys. Refocusing for the long term. We're looking at record our results. So when I do this asset allocation or rebalancing, we first figure out how do we want our money positioned in all our goals, positioned for the future. Secondly, record what that means. Write it down. We're writing down the different categories and components. Third, we're comparing at certain times in the future, 6 months, a year later, reevaluating our needs. Did circumstances change? Do we need to change? That's the time when we might look at rebalancing. Fourth, we adjust, and that is the process of either rebalancing or shifting assets altogether because maybe our needs changed. Maybe the markets didn't change, but our actual needs did. And finally, we normally have to go to outside guidance to control this properly. Now, we're at year end. There are strategies that everyone in this room, I think, can look at in your own situation for year-end tax planning. We do have tax changes looming. We already have some that took place this year. What I want to get into on the tax planning side is we have a lot of different tax rates, income tax rates in today's current tax code. After next year's elections, you know the debates are all talking about tax increases. No, they're not. They're talking about tax decreases. All the conversations I hear are, we're going to reduce taxes. We're going to reduce taxes. But we've got a budget deficit through the roof. So those two statements don't kind of go in hand. We have some problems in our economy, and we actually still have relatively historically low tax rates today. But here are our tax brackets as they stand today. They're higher than they were 3 and 4 years ago. Many of you don't feel that, but it is higher than it was 3 and 4 years ago. We have 5 tax tiers today. We have a traditional income tax. We have the alternative minimum tax that can be superimposed. Once we do an income tax return, if we're not paying enough tax, we might get assessed an alternative minimum tax. Some of you are aware of that. We also have the new, although it's not new anymore, 3% Medicare tax. That's on unearned income. So it's a net investment, I shouldn't say unearned income, net investment income. It's usually unearned income. Earned income is what we work for. Unearned income is traditionally investment income, passive. That's how we think of that. We have PEP and PEAS limitations. Most people are unaware of that. I know some of you in the room are aware of that. What this is a phase out for the highest income earners, whether it's passive income, active income. If you make too much money, it can be about $380,000 a year, let's say on average for a married couple. You run the risk of having your personal exemptions being phased out. That's PEP. And phase limitations. Phase was the last name of the individual. I guess they proposed this, but that is the phase out of your itemized deductions. So if you make too much money, you run the risk of losing itemized deductions. You run the risk of losing personal exemption. So it could end up going to zero. You run the risk of paying an additional Medicare tax. You run the risk of being at the highest possible ordinary income tax rate. And you look at all of this when you're running through this, being subjected to the alternative minimum tax anyway. We have a 39.6% and a 5% incremental rate. So there are higher rates than we had 5 years ago. This chart's hard to read, but I bring this chart up because it talks about long-term capital gains. If you don't get anything else from this workshop, I just talked about this last week or 2 weeks ago on the radio show, I can't remember. It was regarding year-end tax planning. Long-term, I say this in almost every workshop. If you have IRAs, traditional IRAs, and you have Roth IRAs, and you have non-IRAs, non-qualified assets, you have some tax strategies available to you. One of them, anybody in the room, anybody listening, watching on TV, who is in the 15% tax bracket, the normal tax bracket for ordinary income, which means if you're married, you can make up to about $78,000 a year. If you're there, after deductions, your taxable income, you could sell stocks, if they were held longer than a year, at potentially pay zero income tax on the gain. Hardly anybody takes advantage of that. Hardly anybody looks in November, where we are now, at, is that me? Is that me? On my returns? On my statements? Do I have unrealized gains? Do I have unrealized losses? Do I have unrealized long-term or short-term gains? Do I have unrealized long-term or short-term losses? Do I have realized gains? This is tax planning time. This is tax planning month, November. I'll share with you some other strategies why it's not December. We could do this type of planning in December, but we can't do some of the planning I'm going to share with you in December. It has to be done in November. You see this chart? Nobody can read this chart. This chart, I put it up on purpose. I know nobody can read it. These are actual charts that we use in financial planning. They won't all fit on the screen. Part of what everyone in most rooms and discussions that I have need is professional financial planning. That is what I do. So for me to try to get out of my head into your head, don't try to learn all this. Just know that if there are other people that you know want to get this type of information that I share up here, it's hard to get all that out of my head and into your head. I put it up here as an example of the type of sophistication that goes into proper financial planning is deeper and more complex than it sounds. That's why I put it up here. This is just one example. And all it is flying below the radar on long-term care, long-term taxes, short-term capital gains, the PEP and phase out. That's all that is. Now, I use bracket management. If you're in a high income tax bracket, we're going to use software to engineer the most efficient tax strategies. If we're in a low income tax bracket, I can normally phase that through using the same software, but where it's closer to become tax efficient in a low income tax bracket. It's really hard to be tax efficient in a high income tax bracket. In a high income tax bracket, I sometimes have to force money out of an IRA. Now, pay tax, lose 40% of your money. When we didn't have to do that now, and use the net difference to repurchase what we lost in taxes through life insurance. Who would think of that? I'm talking about a whole nother industry. And I'm saying, if I give an insurance company $100,000 and my health is even moderately good, is it possible I can buy a $140,000 death benefit? Maybe. And if I do, haven't I in fact possibly leveraged back what I just lost in tax and gifted to my kids through the death benefit to the beneficiaries, income and estate tax-free, the whole amount of money, totally tax-free, that they don't owe tax on later, and I don't owe tax on now? If I save it, I can even go to my spouse and I save taxes. This is sophisticated planning, folks. So the higher your income, the more sophisticated the plan. This is what financial planning is. Year-end tax strategies, maybe we look at piercing those IRAs, which would seem to defy common sense otherwise. Now we get to harvesting. We're looking at harvesting what? Most people at the year end talk about harvesting what? They're talking about in your stocks and bond portfolios harvesting gains, harvesting losses. But most everywhere I read, they're talking about harvesting losses. They're saying if you have losses in a portfolio, you might want to sell those positions to harvest losses. But I'm going to talk to you about harvesting gains and losses. I don't mean offsetting them in a swap. I mean simply harvesting gains. The reason I'm talking about this is if you have gain positions, things that have gone up, that are otherwise taxable at a long-term capital gains rate. Today, you might be in a 15% income tax bracket. What did I just say the long-term capital gains rate might be in today's tax code? It might be 0 for you. So if I have a stock that I bought at $10, it's now worth $100, and by selling that stock and exercising the capital gain, if it's a long-term capital gain of $90 per share, and no matter how many shares I have, it won't force me out of a 15% bracket, is it maybe prudent to sell those shares? And somebody might say, well, no, because then I have to pay tax, and I wouldn't have to pay tax yet. And I'll say, 0. We're not going to have that tax code forever. It's 0. Then the question is, can I reinvest? I don't want to lose the stock. I like this stock. I have investors say, I don't want to sell the stock. And I say, you don't have to, in essence, sell the stock and never be in it again. You harvest a gain, you sell a stock. Is anyone familiar with how long you have to wait to be able to rebuy a stock if you harvest for taxes? Well, guess what? The rule is more complicated than you think. If you're harvesting a loss, in other words, I have something that tanked, I want to take the loss on this year's returns. It's a long-term loss, let's say. The rules are this. Short-term losses offset short-term capital gains first. Long-term capital losses then offset long-term capital gains first. Both are unlimited in amount. And the amount that any losses exceed the amount of short-term and long-term capital gains are allowed to offset your ordinary income no more than $3,000 a year against ordinary income. That's the rule. But they also say, the IRS tax code says, if you're harvesting losses, you cannot rebuy the same security within 30 days from the time that you sold if you're taking a tax loss on that on your tax return. So you have to wait 31 days to get outside the 30-day window. And many people say, I don't want to be out of the stock that long. When I'm talking about gains harvesting, none of those rules apply. None of those rules. What you have is you could sell a stock that's at a gain. I paid $10. I made $90. It's worth $100. I sell it. I can buy it 5 minutes later. The rule only applies to losses. So you could set yourself up on your returns this year at maximizing a 0% long-term capital gain out of many of your holdings possibly, get out at 0 tax, get back into the security, not even miss that day's close. You could not do that on a loss position. There are other strategies on loss positions to also not have to be out of the market. But folks, it's November. If you take a loss and deduct a loss, you do have 30 days to wait, and in fact 31 to buy it, and we're in the middle of November. So if I teach this in December, it is too late. But in November, it's not. And that's this workshop. And you know what? I even put up here gifting. Sometimes we run into a situation where we have a loss position, and I'll recommend to a client, gift your shares. Why? Kids might be in a 28% bracket. The owner of the shares might be in a 15% bracket on retirement, on Social Security and limited income. And they'll say, well, I'm at a lower income tax rate. And I'll say, but you're at losses. Losses being no benefit to you, because losses can only offset capital gains or ordinary income, all of which is the low bracket for many retirees, but not for your kids. So you gift a stock that went from $100 to $10 that you sold, or even let them sell, because if you gift, the basis transfers to them. And I won't get into details here, but there's a strategy there in reverse of the step up in basis. And if you gift, the basis transfers to them. If they sell the shares or you sell them and you still, well, basically you can't sell them first. You have to gift the shares. They get the basis. They now sell, and they're taking tax losses at their 28 or 35% bracket. It's a huge strategy. That's not only a year-end strategy. Roth IRA conversion, which I'm going to get to here too. The income tax opportunities here are robust, and we're going to lose some of these. Any of you who are interested, write notes. Again, any of you who know other people that should be hearing this and aren't, get them on our email list, because they get value out of this information possibly that they're not getting from anywhere else. But when we look at these planning strategies, we're especially attentive at the end of the year, because we don't have to wait a whole year to benefit by it. We're filing our taxes early in the year. So on the surface, it looks like people should always harvest gains. That's not true either. We look at harvesting gains is a trade-off, and all strategies are. So we're looking at the pros and cons. Tax is paid at a lower rate if we harvest gains in the long-term capital gains brackets we're in right now, but that still doesn't make it right. We have to be very careful when we do things. The other thing is, there's a crossover point where selling sooner versus waiting longer matters. One of them is, if I hold my capital assets long enough and the tax code does not change and I die with those assets intact, my heirs inherit those assets with a step-up in basis and would have paid zero income tax, even though I might have paid a low capital gains tax rate. They might have paid zero. So if I was out of the zero long-term capital gains tax rate, I might still enjoy a 15% long-term capital gains rate, which I think is favorable. But then here, if I pass away with those holdings, the kids inherit and they're back to a 0% because of the step up in cost basis. So it's sophisticated planning when we talk about not only tax planning, but legacy planning. Thanks again, everyone, for tuning in this week. That's the end of part 2 of a 3-part series that I'm doing, airing the workshop, the public workshop that I did. Please feel free to tune in next week to All Things Financial, where I'll wrap up part 3.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.